Good afternoon, members. Welcome back. Now we'll be moving on to the topic of designing and search strategy and TP documentation. To handle this session, we have Mr. Ganesh Krishnamurthy. So I request the Chairman of Bangalore Branch to escort the speaker on dais. I request Chairman to welcome with the floral bouquet. Ms. Kanishida will be assisting Sir onto the desk. I request you also to come up on the desk. I take the privilege in introducing Ganesh Krishnamurthy Sir, who is the Director with the Tax and Regulatory Practice, specializing in the area of transfer pricing and has over 17 years experience in assisting global and Indian MNCs on tax and transfer pricing, value chain planning, structuring, audits, litigation, and competent authority process including APAs and MEPs. Mr. Ganesh had over 4 years in the UK and Malaysia working closely with global multinationals on their transfer pricing policies and audits, assisting many of them in their investment into India. He has also authored various articles in leading tax publication and was invited by the Inland Revenue Department of Sri Lanka in 2015 to present them on the best practices in relation to transfer pricing policy administration. He's also had the expertise and experience of supporting business across technology, manufacturing, retail space, in various industries spanning automotive, financial services, pharmaceutical, logistics, to name a few. He is also a commerce graduate and a fellow member of the Institute of Chartered Accountants of India, as we all know. So, with this brief introduction, I would like you to take over the stage, sir.
Good afternoon, everyone. So, post-lunch session must be difficult, and I'll try to keep you awake as much as I can. The topic at hand is very interesting. When I was informed of this topic a couple of weeks back, I felt that this is the topic that is very timely at this stage of the year, where we do have certain compliance timelines coming up for transfer pricing. So I would expect, and before I start, I just want to make the session relevant for all of you. Because while the topic of transfer pricing is vast and we are talking about a legislation which is just past its teens. So transfer pricing, as many of you will be aware, was introduced sometime in 2001. And we are in 22, so we are looking at a legislation which has been there for over 20 years. Right? So of course, I'll set expectations here that I'm not going to take you through a 21-year-old journey of the law. But what I'll try to do is, I try to share some experiences, practical experiences of how, as professionals, we would be able to do a better work or address the complexities in the subject by looking at one aspect of transfer pricing, which is to do with documentation. So when we talk about documentation, we talk about how do we demonstrate that a transaction between two related entities is arm's length, right? So before we delve into it, I just need a show of hands from the audience. How many of you are familiar with the transfer pricing regulations? I'm not going to ask any questions, I promise. So it's just fine, just for me to understand how I approach this topic. Okay, and how many of you have carried out what is called benchmarking studies? Are familiar with benchmarking? Okay. Again, I promise that I'm not going to ask questions, so don't worry about that. It's just about the level of complexity or level of simplicity, the way we can approach this topic together. I would prefer that, given that we have an hour and a half with us, all of us collectively will go through this as a learning process. Okay, so consciously I've also included some stories as part of this session, so that we can stay awake and we can also learn, right? So with that objective, and I have the privilege of having with me my fellow colleague who is part of my practice, my team, and she has had some very practical experience of transfer pricing. And she is, if I may call Kanishida a Gen Z, so she approaches the topic from her own lens. So I would like you to also hear her point of view, and she talks about her experience with this topic. So with that, what will be covered today? So we will talk about how do you do a transfer pricing analysis. How do we typically approach this analysis? Comparability analysis. So this is the backbone of any transfer pricing analysis, because at the end of it, what is the outcome we are looking at? The outcome is how do we demonstrate that a transaction between two related entities fulfills the arm's length standard. So how do you go about identifying comparables? How do we use databases? What databases we use? How do we apply filters? So we'll go through that. As I said, I'll be doing some case studies, practical, as well as in course of doing going through the various processes. We'll also discuss how practically we have approached it. So there are lots of experiences in India as well as global, which I will try to share in this short period of time with all of you. And then the concept of economic adjustments. As we all know, when we talk about arm's length, it's not one price. It's not one transaction. It is something which is potentially comparable. That's the term we use. And therefore, in our legislation also, we have a concept of range of prices, right? The arm's length range. And therefore, as a subject, transfer pricing is very subjective and very factual. So it depends on the business of the taxpayer, it depends on the features of the market, it depends on the availability of data. So a lot of variables are there. And in that sphere, if we have to arrive at an arm's length range of prices, in most cases we don't get an exact price. So there needs to be certain adjustments that have to be done to those comparable data, and we'll go through some of those as examples. Right? So with that, I will pass it on to my colleague, Kanishida, who will cover a few parts of the initial concepts that we will go through, and then I'll take over the subsequent part. Kanishida, you want to? Yes. And feel free to raise your hand for any questions. It's perfectly fine to interrupt. Just raise your hand and we can address the questions. Need not wait till the end of the session. Yeah? Thank you.
Good afternoon, everyone. Thank you, Ganesh. It was a brief introduction that we had on transfer pricing. As he introduced Kanishida, we are part of the same practice. So I have a few, not more experience as you guys have, very few experience I have, and I would like to share what my experience so far in transfer pricing. Would also highlight wherever I felt difficult or wherever I felt, okay, I would have done something better or looked at something, the perspective better. So from this transfer pricing documentation, it's a requirement by the Indian regulations and also OECD. That the requirement is 3-file documentation, one of which is the local file. So the local file in India is also called the transfer pricing documentation. So which has a structure in itself. The section, the rule 10D tells the requirement for a TP documentation, and also the OECD guidelines plots down the process in which the TP documentation can be prepared. So the requirements, few examples of the requirements could be few examples could be the group overview, in the sense what does the what does the group does? In case we have an Indian entity for which we are preparing a transfer pricing documentation, the Indian entity would have been held by some other entities, and the Indian entity will have subsidiaries. So we have to speak about the business of those holding entities and the associated enterprises, where we say here, which means wherever we have transactions with the related parties. And we have certain thresholds also to say that one entity, which is a subsidiary, becomes an associated enterprise of the Indian entity, for which we are preparing the transfer pricing documentation. So understanding about the entire group is very important, because each one of the characteristics which is given in this ladder are interlinked together. So after completing one aspect, it will be the output of those will be useful in the following aspects. Say, by understanding the group and also by understanding the industry, we will be able to characterize what that entity is. We will be able to find the tested party. We can see in the further slides. We will be able to write down the functions, what does the Indian entity do, what does the group do. We will be able to find out from what we write. So it is not just a content we bring it in the transfer pricing documentation. It is very important to understand and write what we give in the group and industry overview. Moving on to the next ladder is PFAR, which is functions, assets and risks. So it is really important to understand what does India do, what does the overseas parties do, with which we have the transactions. For example, say we have an entity India and its group entity, which is in US. The US is asking India to provide certain specific services, say engineering design. Maybe in particular we can say any engineering design which is related to steel detailing, fabrication, rebar detailing, like that. So here US is instructing specifically India to provide those services. So the functions would be US is maintaining all the intangibles. US is instructing India how much, what are the services to be provided, and US is providing the intangible to us. So India in this case will not have, will act as a captive service provider, which acts by the rules of the US entity. So here we can, with the functions, assets and risks, coming to risks, the major risks are taken by the US entity. As we say, for example, the market risk. We are not covering any market because the final goods are sold to the third parties in the US. So India is just going to provide those services to the US entity. The US entity will thereby provide those services to the US third party customers. So India is restricted only to provision of services to the US entity. So the risks are contracted and the risks are less for the Indian entity here. So with all these functions, assets and risks that we analyze, we will be able to characterize this example as a captive service provider. Likewise, we will have a manufacturer who entirely does only manufacturing and sell those finished goods to others. So there are many cases and we have many examples in the coming slides. The next in the ladder is a tested party, where we have to choose the tested party. And as you all know, we will choose the tested party by way of the least complex entity. As we discussed, the least complex is India here. So tested party here is with which the transfer pricing methodology will be applied to. Say the comparability analysis that we are going to do afterwards will be with the margins of the tested party. Here India, in our example, India is the tested party. The last in the ladder is the TP method and comparability. So the next most important and critical point, and which is very relevant for today's session, is the choosing of methods in the comparability analysis. Out of the 5 methods which is given by the sections and rules, so we have to choose one of the methods, and also we have the 6th method, which is the other method. Wherever it is applicable, we can choose the other method. So in this captive service provider, we can say the cost also plays an important role. So we can choose this TNMM as the most appropriate method in the example that we have seen. And you can also argue that why can't you use cost plus method? There is another method which is called cost plus method. Why can't you use cost plus method in this case? I would say cost plus method, which is the full form of CPM. We will not be able to use CPM because it is tested on the gross level by dividing the direct and indirect costs. So here in our case, the direct and indirect costs are influenced by the Indian entity also. So PNMM is the most appropriate method that we can choose. Why? Going forward, in the full session, we can focus only on TP method and comparability analysis. So in this is a very basic slide which covers about the benchmarking and comparability analysis. The computation of arm's length is covered by section 92C followed by rule 10C and in the series. The choice of comparables the comparables can be either internal or external. Meaning of an internal comparable, say, if we take the same example as earlier, the internal comparable in this case for an example would be if the if the Indian entity is providing the same service to any third party in any other entity, which should be unrelated. So it should be uncontrolled. In that case, it will be an internal comparable which we have. In case of external comparables, that is between two unrelated entities. It is not like one related and one. Those external comparables will be between two unrelated entities. So we have that choice. But the first preference as per the OECD is given to the internal comparables, which would be more precise, which would be more correct to choose. So first we analyze if there is any internal comparables, then we will go to the next step of choosing the external comparables as per the OECD and as per the Indian regulations. Before this, before the comparability and search process, as we discussed, we have to select the tested party and also the most appropriate method. So the next, these form part of the economic analysis in the transfer pricing documentation. And as Ganesh said, there are many databases which are available for which we can rely upon. So what in our practice we use Capital Line TP Analyst database. We use Orbis database. So these are the names of the databases. There are CompuStat. There are several databases which we will have in the upcoming slides. As we earlier discussed, we have the OECD's 9-step process for preparing the benchmarking analysis or doing the comparability analysis. So the first and the foremost step is the determination of the years to be covered. So here, what the rule says is that we have to look at relevant, reliable data. The data that we are looking into must be reliable. The data should be available, as we all know. So the years, say if we are doing a transfer pricing documentation for the current year, which is for the previous year, which is financial 21-22, for which we are filing in the current year. We would require the data of financial year 21-22. In such case, for few cases in the public domain, we will not be able to get the financial data of financial year 21-22. In that case, what OECD allows is to take multiple year data, which is we can take the data for FY 21-22 and also we can cover two prior years, which is 2021 financial year and financial year 19-20. So we can cover 3 years data to arrive at the financial data of the comparables and also to understand their business clearly. The next is the taxpayer circumstances. As we have already seen, where is the taxpayer, what does the taxpayer do, and the comparable should be similar to what the taxpayer does. Then we discussed in the format of the TP documentation, we have to write what are the international transactions. We have to identify, we do not miss anything, we have to identify, we have to write the FAR and we have to finally select the tested party. Then we have to check if there is any internal comparables. As we had a previous example, we have to check for internal comparables. If not available, we have to choose for an external comparable. In case rather than TNM, rather than choosing a transactional net margin method, if there is any other method, say for a transaction where a loan is provided and we are paying interest, in that case, it is to be that transactions are also to be benchmarked. So it will not involve any profit methods. It will have those traditional methods or the other method that we have in hand, whichever is most reliable, wherever we have data availability. That is also stand first when we come to comparability analysis. So we have some we will have some interest quotations from other banks where we can compare, and if it suits our situation, we can choose that as a comparable under the method. 7.1 says potential comparables, as we were discussing so far, that the comparable is to be potential, that is to be reliable and available to us. Then after arriving at the comparables, and we have some margin, we have some price in place as a transfer price, and we see our price, which is the we have the comparables price, and we see our transfer price, and if we see any difference in that, any functional difference, any accounting policy difference, we will be able to bridge that gap by making some adjustments to it. We have several adjustments in place which we will cover later. Certain examples would be working capital adjustment, forex adjustment, risk adjustment, which we have made in practical cases where it bridges the gap between the transfer price and the comparability price that we have reached. Then after identifying all those adjustments and making all those adjustments, we have to document those adjustments in place in the transfer pricing document, which is more relevant when say the client, when say the company gets picked up for a transfer pricing audit during assessment times. Documenting these will be very important so that we'll be able to explain them in a clear position. We have to interpret with the adjusted comparable price with the transfer price so that it is in arm's length. So here we have inputs, we discussed, we have the inputs as industry overview, we have inputs as group overview, we have the functional analysis. All these are interlinked. Whatever we write, we interpret in those industry overview, group and functional analysis will form base for the next steps. For the characterization, for selecting the tested party, for selecting the most appropriate method, doing the benchmarking analysis in the search process, and arriving, doing a qualitative review. It means the business review, whether the business is similar to what we do, and making any adjustments if we require, and arriving at the arm's length price. As we discussed, Rule 10D completely speaks about documenting whatever which is more important to be given in a TQ report. So we can tick it off each and everything which is given there in the Rule 10D. And here, as it's highlighted, it's self-explanatory, and as it's highlighted, it is to be documented as per these, all the documents to be given in the TP documentation by these rules. Yeah, I think we have covered everything in this. So apart from this, the practical experience that I would like to share, the examples that I had, or examples that we have, is that we should be more cautious in documenting what, in putting words in the DP report. It is not so lethargic, as we all know. Each and every word counts, because when it comes to assessment, we will struggle if we have not analyzed it earlier. Though TP documentation is not a requirement for by filing the Form 3CB, we would require so that we would require to say they are an arm's length price, so that the right price is right value of the transaction is reported in the 3CB, and whenever the TPO asks, whenever the revenue authorities asks for the TP documentation, we have a short duration, 30 days, which can be extended to next 30 days. But it is better to always have in place the TP documentation with the right comparability analysis and right method chosen with whatever transactions we have. With this, I leave the next entire session to Ganesh. Thank you. Thanks very much.
So let's spend some time on some stories. We've got a lot of yarn, which is good, which is the subject at hand. So why is this guidance or steps from OECD relevant? So when we look at Income Tax Act and income tax rules, because our taxpayers will be guided by the legislation which is with us, right? Rule 10D of the income tax rules sets out all this information that needs to be maintained by a taxpayer with respect to international transactions with associated enterprises, right? So therefore, the question arises, what is the international transaction that has to be demonstrated to be arm's length? That should be the first point of reference. Okay? We tend to rush into doing an arm's length analysis without understanding the concept. The concept is identify the transactions. So and I'm sure that in the previous sessions you would have had a good understanding of what are international transactions. We covered, I think, safe harbor rules, etc. So you'll be fairly familiar. Coming to this particular one, my colleague covered the 9-step process. I think let's take a step back. Transfer pricing analysis, as I said, is very factual. So when we talk about determination of years to be covered, let's look at right now a situation. Financial year 21-22 is the year before us. 2 prior years, we had an impact, which was an exceptional event that happened across the world, right? So COVID hit all the industries, positively or negatively, every business was impacted, right? So today, when you do an analysis for your taxpayer, you will necessarily not have data for comparables for financial year 21-22 because the audits are still going on just in midst of completion and you will not have the audited financials available, right? Then you have the benefit of financial year 2021 and 19-20, right? Both of these years have been impacted by COVID for various businesses and your taxpayer would also have been impacted, right? And therefore, which years would be taken? Now, under the law, you don't have a choice. You have to take the 2 prior years. You can't say, I don't want to take particular year. But what is relevant for us as practitioners is, you take those years, 2 prior years, do the analysis, come up with an arm's length price, but explain in the analysis why certain impact of market factors are relevant for your pricing of international transaction. It could have been the forex volatility. It could have been the higher freight costs. Because if I'm a manufacturing company, I have imported raw materials from my group company. I had expected freight costs to move in a certain direction, but we all know last year the freight costs actually increased 10 times of what. So the projections were all, there were a lot of variances. So therefore, just measuring and a set of comparables is not necessarily the answer. You'll have to document what impact has happened, and that is very important. I'll tell you another story where I was in the midst of, so back in 2008, when the financial crisis hit, a lot of countries, including UK and US, the Lehman Brothers episode happened and all. At that point of time, we were trying to assess the returns or the profit margins in a specific industry, the alcoholic beverages industry. Okay, I'm sharing this experience with you, so just let us understand how this kind of benchmarking is done. Now, the objective was, there is this group of, this big group which has presence in close to 140 countries. And they wanted to decide how much profit margins they should leave with their manufacturers, with their distributors, etc. Because their business was selling beer. And beer making is a very complex business. You have distilleries, you have a set of distributors who sell it to bottlers and etc. So it's a big supply chain. And across countries, they had different types of functions happening. Manufacturing, distribution, services, so certain administrative, central services, etc. So for services, it was not very complicated because we know that services, we know what services are performed and therefore you can determine a price for the services. So you build a profit over the cost of services and you perhaps can determine an arm's length price. But for manufacturers and distributors, it was complicated because there is an input cost that comes in. They have their running costs, which is operating expenses, other administration costs, etc. And then they have to supply, a manufacturer has to supply to a distributor. So what transfer price do they apply? And contrast that with every country has a different regulation or expectation. In some countries, you have the arithmetic mean, which is the measure of the arm's length price. In some countries, it's an interquartile range. So, therefore, a uniform policy had to be developed. I'll not take you through the entire exercise because this was very complex. But what we wanted to measure at that point in 2008 was, is there an impact of the economic crisis on this supply chain? Very curiously and very interestingly, based on the data that was available to us, it was seen that the margins of distilleries and manufacturers actually improved during that period. The demand only increased, unlike a different industry, right? So I'm just quoting an example that sometimes a crisis does not necessarily result in a difficult situation, it also impacts businesses differently. So as practitioners, when we do an analysis like this, let's not just be driven by databases. We have to use the databases because they contain significant amount of data, and that's very helpful. But we also should know the facts of the taxpayer, the business of the taxpayer, which will enable us to do a better analysis. So therefore, when we say determination of years to be covered, there may be certain years which would have been exceptional. So I'll tell you, for example, if you look at the travel industry, significantly impacted by COVID. So if you have a hotel group or hotel chain who have not been able to report the profits during that particular period, you look at comparables, which probably may not have been that impacted if their asset base was different, right? So in which case, you will have to assess what are the peculiar facts which have impacted my taxpayer vis-a-vis those comparables to choose the right comparables. Similarly, there will be certain businesses which operated, for example, with a lower amount of employee cost, and the taxpayer had a higher amount of employee cost. But some of them may have subcontracted, comparables may have subcontracted their work some companies. So there may be peculiar economic differences between the way businesses were run, and so those have to be considered. So from that standpoint, some of these are very factual and we should respect that basis of doing the analysis. So when we come to the topic at hand, we went through this cycle. The industry overview, I'll give you one more example. So you have, for example, sourcing companies. India as well as a lot of South Asian countries are extremely well positioned for example, the apparel sector, textile sector. The kind of suppliers you see in the Southeast Asia, South Asia is phenomenal. And the reason is because of various geographical location, the talent pool that you have, the kind of availability of raw materials. So a lot of positives for the sector. And therefore, let's take an example. So we have a sourcing company in India. What it does is it is part of a multinational group. The multinational actually retails. It has a branded apparel in its, so it supplies to all the European US markets, very prominent brand. And I'm not making up the story. This is based on a Delhi tribunal ruling for this case. Yeah? So I don't want to go too technical. I want to relate it to you with an example and a story so that you can relate and you can remember. So this company, so this group decided that given the geographical benefit of having India as a sourcing company, they would want the Indian company to interact with suppliers in the Asia region, negotiate with them for better prices for sourcing for all their group companies, so that they are able to overall reduce the cost of procurement. Okay, so this was the objective. It also enabled the group to get better prices because there was bulk purchases by the sourcing company and therefore negotiation happened. Now, the way the transaction happened, what is the international transaction? Because we are transfer pricing professionals, so we will have to look at international transaction. The international transaction here was sales of these goods which were procured. So the Indian company would procure from these suppliers, supply to group companies, right? So that was the international transaction. So when you define that as an international transaction, the test way for us is how do we determine the arm's length price? And I'm just relating it to this diagram here. So if the Indian entity has to determine the arm's length price, obviously the activity of the Indian entity has to be understood. So therefore the functional analysis, what do we do, etc. has to be understood. So we are a sourcing company, we source and sell. Industry overview is important. The reason is because in a sourcing business, there are various models which are possible. You can source, you can manage warehouses where you stock and you supply. You may also package, repackage and supply. You may also do some further manufacturing in terms of some changing, packaging or designing, etc. or assembly of various things, make it into a new product and supply. In the auto sector, you see import of CKD and assembly. You know the difference, right? When you import as a vehicle, the customs duty are higher, right? So many of the auto companies import in CKD, assemble and supply. So in the sourcing also that is possible. So there are various models. Look at this taxpayer. What does this taxpayer do? This taxpayer imports, basically discusses with various suppliers. What they do is, they decide which of the group companies require what products at what point of time. So we are in October. November, a company in Japan requires so much units of a particular product. December, so much products, the same products are required in Korea, in UK, in various countries. So they do a scheduling of supply. This is what the Indian company does. Once they get the orders from all the group companies, they try to see which are the suppliers who can supply. They connect with them, try to negotiate with them the best price and place orders. Once the orders are placed, there is a lead time of supply, say 15 to 20 days. These suppliers are ready to ship the orders to the respective geographies. The Indian company does not stock these products. The goods are supplied directly by suppliers to the respective geographies. The Indian company is invoiced for that product because they raise the purchase order on the supplier and they pay and they raise invoices on the purchasing entities, right? So with this kind of a fact pattern, right? Your industry analysis has to be written in that context, that what is relevant for this fact pattern. So which are the sourcing companies which do a business similar to this? How much is the stocking and a relevant function or not a relevant function? How is logistics a relevant activity for this business? So all of this has to be the focus of the industry only. The reason why I am telling this is, I'll come to the main point in a few minutes. When you do a benchmarking analysis or the determination of constant price, one important aspect that will come in is what should be the profit level indicator, PLI, which is how do you measure the return or profit for the international transaction. Typically, because I am sourcing and I am supplying, right? So I am making a sale to my group company, the sale of finished goods or procured goods, right? So that's the international transaction. Therefore, typically, my PLI will be operating profit or gross profit over, say, the cost, which is incurred. What cost will you take? What will be the cost which you will consider for the PLI? Any thoughts, any ideas?
All costs except administrative, marketing, selling.
Your good name?
Hemant.
Hemant. So Hemant says all costs excluding administrative marketing expenses. Okay, interesting perspective. Anybody else?
If you are going for TNMM, you would take all the costs.
So you will take, what's your good name?
Saket.
Saket. So Saket says take all costs. Okay, if you're going for TNMM. So the method is important in your view. You take TNMM, you go for all costs. Okay. Anybody else? So Saket and Hemant have a good point. Anybody else? So let's take a step back. When you determine what costs you should consider, the costs are an outcome of relevant functions. Okay? I'm just giving you this example. We'll jump into the database, etc., which will be a more interesting part. But this is a conceptual aspect we should all follow. The cost that you take should be an outcome of the functions which are relevant. So in this case, the taxpayer does not perform any function with respect to the products. The products are supplied by the suppliers. The product is on just-in-time, ordered, delivered to the respective purchasing entities. the activity done by the Indian company is to coordinate, negotiate, get better prices, and ensure that the logistics is managed efficiently so that the products are delivered at the right time, quality is managed, etc. But to the products itself, they don't do any activity relating to the products. So the question arises, why should the cost of products be relevant to the compensation? Should the activity be measured by the expenses which are incurred with respect to this coordination, logistics, etc.? So should we take only the administrative expenses and not the cost of products as a base on which you determine your profit? This was a fact pattern in the case of gap sourcing. Gap is a very prominent brand, a Delhi tribunal ruling, you can read it, where this concept of pass-through costs were considered to say that in the context of that business, because the activity relating to procurement of products is not so relevant, you should consider something which is the basis value-added expenses. And therefore, taking a step back in our taxpayers pattern, and the answer that you gave would obviously be relevant in a different fact pattern. But what happens in transfer pricing is it's very factual. In another case, you will have a procurement company actually doing a lot of activity relating to the products. There you take a TNMM, you apply the total cost, you may need to do that analysis, right? So depending on the facts, the answers will change. So I just want us to be able to be flexible with the analysis that we consider. Rule 10D we talked about. I will come back to it for some references. Let's go into the methods quickly. And I hope we are all familiar with Rule 10B, which sets out all the methods which are prescribed. The 6 methods, right? Or 5 methods?
Including other methods, there is
6 methods.
There are 5 prescribed.
Excellent answer. 5 specified methods and 1 unspecified method. So that's the answer I was looking for. Very good. So, and this is important because the other method comes into play when you do not have exact data. So there are businesses which do transactions where there are no comparables. How do you then measure the outcome? So the other method comes to our rescue. I won't go detail into each of these methods, but important thing is we have a price-based method, which is a CUP method. The preference is for price-based methods generally because they are more direct. They establish the arm's length nature very clearly. So if you have a price you are paying to your related party, similar price to a third party, if the transaction terms are similar, then you compare the price. Most definitely the best way to compare. Practically difficult, most cases cannot be applied. I'll say the practical aspect because I deal with it day in, day out. 85% of the analysis that happens in transfer pricing revolves around profit-based methods. 15% is other methods. So therefore, you come down to profit-based methods like resale price method, which generally gets applied in distributors, cost-plus method, TNMM. Other method as well. I'll come to some examples as we go along. As I was saying, the chronology of the methods is important. In the US, you have something called a best method rule. In India, you have something called most appropriate method. Rule 10B, Rule 10C talk about methods and the most appropriate method. And Rule 10C talks about the factors which should be considered for comparability. So therefore, from that standpoint, we should consider all of these methods, whichever is best applicable to the transactions. And practical applicability is also set out. I will not go into it. Suffice to say that in most cases it's TNMM which finds application and other method in a lot of cases. Where do we apply these methods? The CUP method finds application to certain financial transactions, loans, because interest rates on borrowings are fairly available. Public data is available for interest rates, and therefore you see that in loans you can apply. interestingly, it is a very vast area. Financial transactions is a very vast area. Nowadays, there are complex form of loan instruments, hybrid instruments. So therefore, it creates an opportunity for us as practitioners to find out different ways of measuring arm's length price. So it's not a very simple taking a interest rate from a nationalized bank website and say it's arm's length. It's not so straightforward. We should look at various factors or the terms of the instrument that is under review between the related parties. Accordingly, choose the comparator. So that should be the way we should go about. So then there's royalty. So royalty is something which is paid for technology, technical know-how, brands, etc. So the reason why CUP method is considered is there is data available for royalties paid by similar entities. There are databases which capture this data. Very simply put, many of you will be aware, in the US, there is something called Securities Exchange Commission, right? Most of the companies in the US, especially the listed companies, have to file certain documents with the SEC. And this includes a lot of these agreements which they have entered into with third parties. From those, there is a database that is created or a list of agreements which are created which capture royalties, etc. That's how the data becomes available. Many years back, in India we used to have this. There used to be a pool of data from where you could capture the royalties which were agreed between entities. Nowadays that data is not available, but it used to be. So similarly for guarantee fees, etc., you can seek up, and therefore the other methods, the resale price method, typically in a distributor, cost plus method, typically in a sale of finished goods or semi-finished goods or services. Slight difference between cost plus method and TNMM. Cost plus method deals with direct costs. Do not consider all the indirect costs, so direct costs of production. Profit split method is about integrated activity. So multiple people involved in, so typically you have joint R&D projects where 3-4 companies come together and fund the R&D activity, and therefore the returns from that R&D is measured by way of a PSN. So some of these examples will be relevant to some of the case studies we do. And the other method, the caution that I would advise to us as practitioners on other method is, and I've seen this as practical examples, where we can't apply any method, a lot of accountants say other method. Just be very careful, because today, right now, we see that our tax administration, our people at the tax office are extremely intelligent. They look at ways and means of picking up cases for scrutiny. Today we have a risk-based audit, right? Historically, we used to have a materiality threshold. So for example, if the value of international transactions exceeded, say 5 crores or 15 crores, cases used to be picked up for transfer pricing scrutiny. Today it's risk-based, which means certain disclosures we make in the Form 3CEB will be the basis for picking up cases for scrutiny. Materiality will be there, but in addition to it, say, where is your associated enterprise located? Is it in a tax haven? Are you applying another method without any explanation, for example? So these are parameters which can be picked up. So let's be careful in applying the other method. The other method does not mean that I don't perform any analysis. Right? So that's something that I would say we should exercise caution. And therefore we've seen typically, practically, other method is applied where, for example, there's a valuation report for an import of second-hand machinery. Or for that matter, there is anything relating to financial transaction. I think we spoke about one example where you undertake a transaction, borrow from a group company at a certain rate, you ask for quotations from your bankers for a similar term, what would be your interest rate for it, and you compare that. So that's necessarily not a CUP method because it's not comparing yourself against an actual transaction, but it's a similar, potentially comparable transaction, and therefore another method. So these are practical aspects we should bear in mind. And profit level indicators will vary by the methods that you apply. So these are some of the profit level indicators I've indicated here. There can be others beyond this as well. So these are typically considered for the different classes of businesses. Now let's come into the benchmarking analysis. So my colleague mentioned there are various databases. There's Prowess, which is a database center for monitoring Indian economy. There's a lot of data which is compiled and a wealth of data, to be honest. HTP, Capital, and so there are various other databases. The key point is, what do we want to search for? Right? While the databases are having wealth of information, what do we need? What is the benchmarking we need to do? So first define the international transaction, then search for comparables. Right? So these databases on the left-hand side are mostly companies in India. You will have data on them. On the right-hand side are the foreign databases. These are some examples, but there is Osiris, there is Orbis, there is Oriana. So a lot of the foreign databases exist. Where this you can use, where say the overseas entity is selected as tested party. I'll give you an example. The Indian company is a manufacturer, develops a new line of products. So for example, it actually comes up with, let's take an example of electric vehicles, right? So the Indian company actually conceptualizes, invests, does the R&D, comes up with electric bikes, okay? And there are distributors who are set up in Europe and US who actually market these in their respective countries, right? So the Indian entity actually develops this, supplies, exports these products, exports these bikes to the US and UK, for example, where the distributors then demonstrate or show these products in various exhibitions, and they are then selling it to customers. And we don't need to go into much details, but suffice to say, between these two entities, who is the lesser complex entity, whose financials can be reliably measured? The Indian entity is the R&D, is the entrepreneur who's developing the product, and therefore, relatively speaking, the distributor is an easier entity to measure, for the reason that the distributor will expect a consistent profit from the operations. And why do I say that? A distributor will always be in a position to exit if the products are not profitable. So tomorrow the distributor says that I am not able to generate profits by selling the electric bikes, I will move to some other supplier and purchase and sell, because my strength is the ability to sell, right? So if your products don't give me profits, I move to another. So therefore the distributor will always have the objective of making profits on their distribution activity, whereas the entrepreneur in India who is developing the electric bikes may or may not be able to come up with a product. So there's a big risk lying with the R&D. So considering these, if you select a distributor as a tested party, then you look at comparables in that geography. So if it's UK, US, you look at local databases, you look at local comparables, and that's where the foreign databases come to use. It's a recognized principle in the Indian, many judicial rulings in India, where foreign databases have been accepted, foreign comparables have been accepted, and that has been adopted by our courts also, so it's a preferred approach as well. So how do we do a typical search process? Start with the universe of companies. In most databases, you will have over 10,000, 20,000 companies to start with. You filter that further to say which industry am I looking at. So is it metals, is it automotive, is it consumer goods? So you select, and honestly these databases are very user friendly. You tick the box which is relevant and you come up with a set of comparables. That's how it works. Of course, you have to do some quantitative screening, which is to say you want to set up something like a turnover screening, saying that I don't want very small companies to be comparables. I don't want very large companies to be comparables, because my taxpayer is in a certain bracket. So can I select companies in the same scale? Can I select companies which should not have negative net worth, which are loss making? Can I select companies which do not have related party transactions? So those are the parameters one can choose. If I am predominantly exporting products, I don't want to compare myself against comparables which are selling only in the domestic market. I would also select companies which are export oriented. So I will apply an export filter. So these are things which we as practitioners have to start thinking. There is nothing in law. Law does not set out which filters you should apply, but as a businessman, as a practitioner, as an advisor, it is up to us to apply those. So I must also add a word of caution, whatever filters we apply should be logical. Because these are what will come up in potential and assessment proceeding where the revenue will say, I don't accept your filter. I don't accept your way of search, so I will do my own search. So therefore, we should be very confident of the way we have applied. And you can use certain exclusions also. So we talked about internal comparables. Now I will tell you another story on internal comparables. Many years back, we were doing an analysis for a company in India which was supplying conveyor belts. So they manufacture conveyor belts. And where do these get used? They get used in industries, FMCG companies. They also get used in airports. So the airports, for example, the packages that come in the conveyor belts, so they import it from this company in India. And this company also had distributors in various geographies, in Asia, Europe, etc. So the problem before us, or the problem statement, I wouldn't say problem, it was a problem statement made before us by the company management was, help us with determining how much profits we should keep in India for the supplies made to our group companies, because we don't want to be seen as shifting profits from India. We want to be seen as a responsible taxpayer. So help us. This was a problem statement. So what did we do? The ideal way would have been go into a database, search other companies similar, come up with a profit margin, tell them. We thought that while that answer the company could have themselves found out because they know their competitors better. They would know what competitors who are supplying at what price. Right? How do we add value to that business? So we came up with a very different approach. What did we do? We said, okay, let's look at your business. Let's map out which geographies you sell. Where are your group companies located? So we figured out that the group companies to whom they supply conveyor belts are majorly distributors. So they buy and sell. And those group companies are located in Europe, in Germany, in France, in UK, in certain countries, the group companies. And they supply also to certain third-party distributors or independent distributors who are in other Nordic countries, Switzerland, Austria, etc. Okay? So wherever they had their own distributors, they supplied to the distributors. Whichever countries they didn't have their distributors, they supplied to third parties. Okay? Similarly, in Asia also the same model. So we said, okay, how do we do a comparability? So we said, let's make clusters. First of all, we have to understand whether those economies are the same. Do they behave in the same manner? Are the terms of supply the same almost? So we looked at the supplies made to the group company in Germany vis-a-vis the group company, the third party in, say, Austria. We said, let's look at how much volumes are sold. How are the products purchased and used in that country? It was a very extensive analysis, but at the end of it, what we came to is, we said, there is some level of similarity between these two transactions, with the group company as well as the third party. We said, Europe operated in a fairly consistent manner. Whether you sold to Germany or whether you sold to Austria, the currency was euro at that point of time. So the currency did not create any difference. Second, the terms of transactions, we looked at the payment terms, the freight terms, etc., were consistent between the two. Because from the Indian company standpoint, they did not make any difference. They did not actually treat the distributors differently. Just because one was a group company, one was a third party, they did not impose different terms. Terms were same. It was just from a commercial standpoint, they didn't have certain distributors, group companies in certain territories, so they worked with a third party. So eventually we landed in a situation where we said there was internal data available where we could say these third parties on the supply to them, we made so much profits. So that became a reference point for my group company supplies. Right? So the reason why I bring up this example is, many cases in transfer pricing, you don't have to search anywhere out. The taxpayer themselves will have the answer. So be very thorough in your understanding of the industry and the data that your taxpayer gives. And feel free to ask many questions. Because transfer pricing is such an inexact science that you will find the answers there itself. So in this case, I wanted to leave this example in your mind because sometimes we get into the analysis, look at databases and try to give an answer. And that may not be the right answer. So I thought I'd share this example. External comparables, various sources, including, why do we need to go into databases, newspaper articles. There are industry publications which come up. We looked at many years back, even now we do this. Wherever there are, in the hotel industry for example, you have a concept of franchising, right? Franchise agreements. So there is one group entity which allows the franchisee to run the hotels in a certain format, for which a brand is licensed, for which certain technical process are licensed, etc. How do you get comparable data? So there is a publication which is on franchises. If you get hold of that, that can be a very useful publication to see what kind of franchise arrangements are entered into with third parties. So while there are very organized databases, there are third-party data which one could look at. Government publications, a lot of extensive publications from government, and industry associations. Periodically, there's a lot of research that comes in that can also be used. More importantly, the time period that is selected. This is again very important. Rule 10 CA of the income tax rules. Please go through it very carefully. Talks about the period of data that has to be used. Current year, previous year, for which method, how many years data will be available or used. To the extent that if your current year data is not available now, but in the future it is available, and the current year data indicates that your comparable is not comparable, that comparable cannot be taken. So it is something which is very important, the selection of the time period. We talked about briefly the filters which I used. The filters, application of filters become very important, especially in the context of, say, the R&D by sales. So if you have comparables which are doing high level of R&D, obviously there will be certain outcomes of the R&D which will benefit the company in terms of better pricing, better products, improvements in the supply chain, etc. So the outcome which is measured by profitability can be very different compared to, say, if the Indian entity is not undertaking R&D. So these differences need to be appreciated. Stock holding, we spoke about one example, but typically inventory levels of businesses are extremely important. How much inventory I hold vis-a-vis my comparables, that creates a difference. The other aspect would be credit and cash. So if I am able to recover my business, recover my collections in a very quick manner vis-a-vis my comparables where it's stuck because they've given a longer credit period, the outcomes will be very different in terms of profitability. And of course, other criteria like bankrupt companies, startup companies, etc. When I mean startup, I mean early stage companies, so companies which are recently set up. You compare yourself against them, they will be loss makers. You may be profit making or lesser loss. So for example, we've seen in situations where companies undertaken certain transactions, they are in the first year of operations, they have not been able to turn a profit and they have paid higher royalties, they have paid higher management fee, etc. They're good companies. And the taxpayer has done some analysis and come to us to say that I am making a negative 1%, but my comparables are making negative 10%, so I'm upset. you see the approach. I am making negative 1%, my comparables are making negative 10%, so I am arm's length. When we go into the analysis, we see the comparables which are selected are making heavy losses because of other reasons, not because of business reasons. And they, in many cases, are not carried out their manufacturing activity in that year. Some extraordinary situation will arisen. Whilst we do have those comparables, it is important to go through it to see whether they are real comparables or not. You just can't come to an analysis without a clear understanding of the comparable. So, therefore, this level of other criteria becomes important. So, these are various approach steps, because at the end of the day, what are we working towards? Getting a set of uncontrolled or independent transactions to which we will compare ourselves against. So data availability becomes extremely important. Are the data available for such independent transactions? If my industry, if I am operating in an industry which is monopolistic, where there are only 2 or 3 players in the industry, you will never get independent data, right? Because there are no other players. Even if there are, they are very small. So you will never be able to compare against similar businesses. Should we look at businesses where the supply chain is very similar? May not be the same products, but similar supply chain. So should we broaden our horizon on industry to other sub-segments or sub-classifications? So that's a thought. So based on functions, we could look at comparables. So typical way of doing it is, if you were to work with a database, if I have to select from 25,000 companies, which is a universe, we have 2 choices. We can spend an entire week going through the 25,000 companies and get to comparables, or we can work smartly. We apply a filter called manufacturing sales by total sales. Because a lot of companies disclose whether they are sale of manufactured products, etc. And the databases also give you that classification. Therefore, you apply a filter called manufacturing sales by total sales. Put a threshold of 90%, 80%, etc. So then the 25,000 companies comes down to say 8,000 or 7,000 companies. You will deal with manufacturers. Now out of that, then how do you further bring it down, refine it to the exact comparables? So therefore, these are some approaches. Manufacturing I talked about is one of the easier ones. If you go into services, it becomes even difficult, because there are a lot more companies. If you say services, it's a vast ocean, right? Different types of services. So there, how do you come to a more reliable sample, reasonable sample? We may have to apply more filters. Sales is a criteria, the size of the company. If I am providing my international transaction with my group is provision of software services. So I actually develop software for my group and they compensate me for their development activity. That is my international transaction. Should I compare myself against an Infosys or a Wipro? That will be the question before me, because they are also doing software, right? So then the question will be, should I be earning 30%, 40% margins? Because they also earn. So we have to understand the facts of the taxpayer, saying that does the taxpayer have that kind of a brand? Do they have those intangibles? Do they own it? Are we therefore similar or dissimilar to these large companies? So we have to bring that reference. So therefore the sales criteria becomes important. Net worth, very important. Whether net worth is negative, positive, less than 0, is that a fair way of comparing? So I'll give you another story here. One of the UK companies in the UK wanted to enter into India. They were in a very peculiar business. You see these movie screenings, right, in the halls. You have these screens, big screens. So they actually manufacture those screens. And they saw that Indians, by nature, we love cinemas, right? So they wanted to enter into India with that product, to say that they expected, and this I'm talking about some 4 years back, they expected that this is going to be a big market, because we are having more cinema halls, we are having more people, in fact we are having private screening now, so there will be a lot of demand for screens. So they said we'll enter into the Indian market. They approached to say that, please help us understand what is the expectation in India with respect to, and what is the kind of sales trajectory we can have, what is the kind of market penetration we can do. Because interestingly, they studied that in India, the growth is in the tier 2 and tier 3 cities, not so much in the metros, in terms of the number of screens coming up. So they felt that is a big opportunity. So we were talking and they came up with this, that one of the questions was, how much should I be retaining in India as a profit? Okay. So they came to us to say, okay, we've been given a study by somebody to say that because this is heavily R&D driven, these screens are made of certain materials which are very proprietary. We own the materials, etc. So we want to retain profits in the country where this is developed, because a lot of R&D has gone in. So we would typically like to create or leave a marketing return in India, because these products are going to be marketed to the halls, etc. So the level of activity in India would be fairly limited. So that was their initial explanation. I will not go into detail of this, but the peculiar area where I was a bit, I was surprised to see, is they got an analysis which said that somebody has done some analysis from databases, used certain comparables, and said that most companies who supply these screens are making losses in India. So the expectation is most companies will make losses, so even if they set up an Indian company, it's okay to make a loss. Because all the industry players are making losses in supplying of screens. So we looked at it. I looked at it very closely, and a common thing that emerged was many of these companies, which are so-called comparables, were owner managed. There was only one shareholder in India who was running that, and somehow that owner had other businesses. There was diversification. So the business, the return that owner was having or earning from the sale of these screens was not being, perhaps there was not much focus or there was not much market, whatever the reason, but it was not really a commercial outcome, is what I would say. In the sense, there were certain other factors which could have contributed to the loss-making situation of the comparables. So comparables were not really comparable. That was the point that I was coming to. We therefore looked at wider industry, similar supply chains, where the product is more important than the supply. And we came up with a range of returns that a distributor of such screens could earn. So the point that I'm making was the facts when they come to you in terms of how much I should keep in India, or you would see situations where there will be comparables which are making losses. A businessman will never enter into a business to make a loss, right? And that can never be an answer that my comparables make a loss, so I should be making a loss. So that's something that just be aware as a practitioner. So we discussed some of these quantitative filters and qualitative filters. Employee costs can be very relevant in a case where a lot of employees, so it's basically employee-driven businesses. It can be in services mostly, so the employee cost by sales may be a fairly big number, and that can be relevant to the outcome from an international transaction. We discussed many of this, so I'll just skip. The related party filter is another important one, which is to say that we should not select companies which enter into related party transactions, because their outcome or their profits are themselves into question whether those are answered. So you cannot select them as comparables. In the law today, we don't have anything specific on what should be the threshold for related party transactions. There are enough and more judicial rulings from tribunals which say, some of them have said 10%, some of them have said 15%, some of them have said even 1%. Companies having 1% related party transaction, you can't choose as comparable. So there are various rulings. Typically, the answer has likely settled at 15%, saying that any company comparable company, which is having 15% or more of related party transaction related to sales, you should not consider them as comparable because they have significant related party transactions. So these are aspects that one can look at as a guidance for determining the filters. We talked about economic adjustments. There are various adjustments that can be done, but any form of adjustments to uncontrolled prices can be very risky. Risky in the sense, there should be sufficient logical explanation to why you're doing it. It cannot be done just to bring in a lower arm's length range, right? I'll give you an example. There was a company which started manufacturing carpets in Pune. It's again a decided ruling. So all my stories are based on either things that have happened, rulings that have come, so I'm not making any of these up. So this company manufactured carpets. In the business of carpets, one of the things is that they were supplying these carpets to corporates. Okay. The business of carpets, there is a lead time. So from the time you start manufacturing, you receive orders and you supply, there is a lead time. You don't get your orders from day one because you need your marketing team to go there, you have to display, right? And then you get orders, then you manufacture, then you supply, you install. So a lot of the time. And so the first 2 years, they were not able to generate profits. It was a foreign company, foreign group, and the India company was manufacturing and supplying. And the Indian company was not able to make profits. On the other hand, they ended up paying certain technical support services to their group company, which was aiding them with how to design those carpets. So they ended up paying all those, but they couldn't make profits. The question was whether those payments that they made out to their group company are the arm's length, because you have not been able to generate any profits in India, but you are making payouts. So in transfer pricing, because transfer pricing in the law is under Chapter 10, which deals with anti-avoidance, basically avoidance of tax, right? So therefore, was this an arrangement to avoid tax? That you made losses, you paid out royalties, etc. So here, there was benefit given to the company to say that there is a commercial judgment here that you were making losses because you were in an early stage of operations. And therefore, it was not on account of the payouts made. In fact, without the payouts being made, you wouldn't have even been able to generate customers for your India business. They were also able to explain, because the good news in India is your assessments happen a year or two after your actual year completes, right? So by the time you are in an assessment, you have some more data. So in their case, they were able to explain that they were able to generate more customers in the later years. So that information also helped to say that the earlier year was a startup year. They made payments to their group companies, which was based on certain pricing policy. So there was a set of comparables they had selected to see how much they can pay out to their group. So while that transaction was benchmarked, because they were in an early stage, they were making losses. So they were able to justify. So therefore, that was one way to do it. The other way you look at is something called a capacity adjustment, which says that generally, if I have a 100% production capacity that I can manufacture, I was able to only produce 10% of that. But my fixed overheads, therefore, would be 100%. Right? I have incurred the full expenses. Should I recognize only 10% of the fixed overheads as part of my operating cost? So that is something in transfer pricing, the question of capacity adjustment comes in. That I have incurred depreciation, which is for my assets which have been utilized during the year, but I have been able to only manufacture 10% of capacity. So when I compute my profitability from my international transaction, should I consider only 10% of my depreciation or 10% of my fixed overheads? Or should I consider both? So there are various judgments on this also we can refer to. But the point is, the economics of it has to be explained. Why have I entered into this? What is this capacity adjustment? Why is the capacity not being utilized? When was I able to utilize it fully? Was it because of certain challenges in the market, like customers placed orders and they went back, or was there any other reason? So these are aspects that one has to cover. So the quality of data, the purpose of adjustment, all of this has to be explained. So this is an example of where a working capital adjustment can be relevant. So my tested party in analysis has a collection period of 30 days. So I collect within 30 days from a group company. Whereas my comparables have a higher collection period, right? And therefore, there is a significant difference between the two. Consequently, a working capital adjustment is performed. So there has to be certain economic basis for any adjustment that we do to the comparables data. This is a formula. You will have the material with you. You can go through it. This is the way the working capital adjustment is done. Where is this coming from? The OECD has published a comparability paper which is available to all of us. Go to the OECD website, you can look at that. There are formulas which are recommended. This is coming from there, that one can use this as a basis to adjust. What are we adjusting? The return which is blocked in the working capital. The interest rate. So if the money was not stuck in the working capital, it's essentially like interest rate on loans or interest rate on borrowing. So therefore, working capital adjustment is unadjusted profit level indicator. So the operating profit over total cost, the percentage, plus the adjustment factor that is added. And then therefore the adjustment is written. Then there are other forms of adjustment. So I'll give you another story here. A prominent Indian conglomerate, I can't name the company, they wanted to establish, this was 10 years back, establish a manufacturing facility in Bangladesh. So they had operations in India, across the world, a very prominent conglomerate. They wanted to set up in Bangladesh. And the question that was raised before us was, how much returns they should earn for a manufacturing activity in Bangladesh. Typically, you would need to look at data, similar companies in Bangladesh, etc. At that point of time, there was no public data which was reliable in Bangladesh. There is no direct access to any audited financials. Unless you ask, you won't get. So it was very complex. So what did we think we did, or what did we do? We looked at a country risk adjustment. We said, we have data for India. We have Indian comparables. And we did an adjustment for purchasing power parity between the two countries. Where did we get guidance from? In the US, in fact not in the US. US also has it, but in South Africa, another country. South Africa faces a limitation of comparables. You don't have good comparables in Africa. And South Africa always has a challenge. South African Revenue Administration is a very, I think, an evolved mindset in terms of how do you look at comparables. So what do? They look at European comparables. And they do an adjustment for country risk between the European country and South Africa, based on certain parameters, say purchasing power, other inflation adjustments, etc. They come to a conclusion that if a European company earns an operating margin of 10%, a South African company would probably earn, say, 5% or 3%, which is acceptable. I'm just giving a hypothetical example. But this country risk adjustment therefore becomes applicable. So in the case that I was talking about, we did an analogy, we used this kind of a technique to determine what could be potentially the returns that a manufacturing company, the related entity, can earn in Bangladesh. So these are techniques, parameters available if you were to consider any economic adjustments. We talked about this databases available, Orbis, CompuStat. These are licensed databases. So these are not free databases. We have to subscribe to them. There is a lot of wealth of information which is available, which could be considered for various countries. This is available for you. I just thought for the benefit of all of us, we can look at some of these. I would add a word of caution. I am not advocating myself any of these databases. I am not a salesman for these databases. Let me make it clear. These are practical experiences. We've seen these, we have used these, and they have tons of data which could be leveraged. So depending on which ones you require for your analysis, you could consider any of these. One unique criteria with foreign databases is, we talked about related party filter, right? Foreign databases have different criteria. You have A plus, A minus. These are independent criteria. They are classified based on shareholder percentage, shareholding in the countries, in the respective companies. So companies are classified on this basis. So typically, you would select companies which are A plus, A or A minus as comparables because they are less than 25% shareholding. The assumption is, if there is a less than 25% shareholding, typically the related party transactions will also be lesser. This is the assumption, may or may not be true, but to start with, one can look at this filter. So what I'll do is, I'll probably focus on one case study in the interest of time. So let's look at this particular case study where there is a company A which is based in the US. It is performing a range of activities. The designing of corporate strategy, the IT system solutions, supply chain management, sales and marketing, and quality assurance. And it is working with a company B in India which is performing certain functions. And what do we do? So between these companies, the question is, how do we assess? First of all, what is the international transaction? Let's understand that. In this example, if one of you can point out what is the international transaction that we see. Anyone?
Service provider. It is of the IT services.
Exactly.
Now recruitment, I'm not sure, it's not clear whether it is recruitment for domestic purposes or recruitment for the AE also, that is not clear. Quality control is a outcome, so it follows the quality guidelines while rendering services, that is what I. And administration, of course.
Sure.
In-house administration.
Sure.
So one is service provision of IT services to the staff recruitment and
Sure. You're absolutely right. So provision of IT services is the international transaction. And the activities that are done by company B for the provision of IT services are listed here. Right? So once we are clear that this is the transaction, and assuming we have looked at all the methods and we've concluded that the TNMM method is the most appropriate method because we looked at various CUP, etc., resale price method not applicable, etc., we concluded TNMM. How do we go about selecting comparables from external databases? So we look at, for example, the turnover filter. We look at this company B, what is its revenue, right? So assuming it's 50 crore revenue, okay. So can we look at, say, 5 crore to 500 crores as a basis? Where am I coming from? Again, Bangalore tribunal rulings, the 1/10 to 10 times. There are various others, some rulings which are relied on Dun and Bradstreet classification, exactly, 0 to 200 above, etc. So you could use various criteria. More importantly, as I think the biggest opportunity of doing this kind of a benchmarking is when you have this conversation with the taxpayer, you will be better informed about their business and the industry. So if you're able to rationalize why did you select a certain filter, why did you select 0 to 200 or 5 to 500, and you are able to say, I can't compare myself against such big players because of this reason, the taxpayer will appreciate that you know their business better than them. Right? So this is a big opportunity as practitioners we can get by doing this kind of a benchmarking also. And then therefore we look at keeping companies with R&D and turnover less than 3%. Generally for services companies, fixed assets are very less, generally nil, but so therefore you create a criteria for that. So, and the qualitative criteria, you could look at business descriptions of the type of services, if we can give, because a lot of these databases allow you to use keywords. So you can type in keywords for the type of services description, and these keywords are taken by the database from the business description of the comparable companies. So they tie the keyword you given against those that are describing the principal business activity, and then they throw out the comparables. So some of these criteria, and we run this kind of a search in a database, which is again available to you. Various criteria, and then we give up. So if you can see, out of close to 60,000 data set, 59,292 data set, we've come down to 8 at the end. So the interesting thing is turnover greater than 0 brings you from 59,000 to 10,000. That's a huge difference, right? So you have close to 49,000 companies which have less than 0 or turnover, greater than 0 is only 10,000. So this is important. So some of these parameters you could select to ensure that your time to do the work is minimized and you're able to deliver a high value at the end. So I will pause here if there are any questions. I have covered most of these points, so if there are any specific questions, more than happy to. Yeah, please, sir.
Sir, in case we have comparables for say 3 years, let me take, and suppose I have say about 7, 8 or 10 comparables, companies that I have selected, and of which maybe 2 or 3 of the companies only have last 2 years data, the current year is not yet, I mean the latest one is not available. Can I consider them or should I exclude?
No, you can consider them. The only thing you would also add, sir, your good name, sir?
Rajesh.
Rajesh. Yeah. Mr. Rajesh, the thing I would encourage you to do is, once you complete your compliance and you have given an answer, when the data for the current year becomes available, check that the company still is a comparable. Because the tax administration, when they do the assessment, will have that data available to them. And if that company is not a comparable, that entire data goes out, and if that impacts your arm's length range, it will be difficult. So you would select them, but you have to validate them, because Rule 10CA is very clear in that regard. It says that if you do not have data for those for the current year, you use 2 previous years, which is fine, but subsequently the current year data becomes available and it renders that company non-comparable, then that company will go out.
Assessing officer is empowered to check.
No, it is the way the law is.
Yes, exactly.
Yeah.
That is, it is to override that impossibility.
Exactly.
I cannot plead saying I did not have data.
You're absolutely correct. Because that was coming up before the courts.
Of course, for impossibility. I
Impossible.
cannot be predicted to have data which is on the day.
Yes.
So that is where the amendment came. So
Absolutely.
that they can go back and say, look, I have it today. I can do it.
Yes, exactly. Exactly.
So validation subsequent.
Yes. Yes.
And one more question, sir. Can I ask?
You can please ask.
I have say 3 years of data, right? So we're supposed to take a weighted average.
Yes.
But the weighted average has got some, I think in the last session I happened to see one slide which said sales by cost.
Sales by cost.
Sales by cost. So that should be the parameter for which to determine the weightages for each year.
So weighted average. Go to Rule 10CA.
Okay.
There are 3-4 illustrations.
Let's see.
Sales for each year. So if you, for example, take OP by sales as the PLI, first of all, you should decide which is your profit level indicator. Operating profit over sales, let's assume. For 3 years, data is available in your example. So 3 years, say company comparable A, which has an operating profit in year 1, year 2, year 3. Sales in year 1, year 2, year 3. You add the operating profit, you add the sales. The combined operating profit by sales is your weighted average for that company.
So that automatically takes care of weightages. So
Exactly.
so
So you don't do average of the returns, not average OP by sales of each year and that. That is not the way. OP ad, sales ad.
And then
Yes.
OP ad, OC
Yes.
ad, and then OP.
Correct. You can see the Rule 10C, it has illustrations. It is very clear, actually well illustrated. That should be able to guide you. Any other questions?
So,
Yes.
so now that we will be doing the benchmarking for 21-22, can we take 3 years and keep whatever little number of companies are coming for 21-22 also, and then later do it again for the entire 3 years, or should we now do only for 2 years, that is 19-20, 20-21, and totally exclude 21-22, and then later do for the entire 3 years?
Great question. It's a super question, very practical, and I appreciate you for that. Typically, if you see, it all depends on the threshold. When do you do this benchmark? Right? So, if you're doing today, you may have some companies who may have reported. Most cases, except listed companies, you will not have data. Okay, practical challenge. You cannot exclude a company just because they have only 21-22 data, etc. So, if you get it, like for example, from experience, services companies, you can get enough and more data for financial year 21. Many of them have reported already. You will get a better coverage. Manufacturing, very difficult. Or for that matter, even specific logistics companies, etc., difficult. Many of them are not reported. Most of them are private companies, so you will not get the data. So, suggestion would be, whatever data you have, you take a cutoff. Say, I say this is October 15. We look at what is available today. Take a screenshot that this is what you found, because you've done a reasonable compliance. Take a screenshot. We generally say on which date we did the benchmark. So we have the cutoff date, we record it, and we say this is when it was done. For the comparables you've selected, for which you did not have 21-22 data, as I told you earlier, you can refresh it subsequently to say, I have this. Just because a company reports financial year 21-22 data, you cannot take it unless it is comparable. The burden of proof is only to the extent that you've done a due diligence, you've searched, you've got what you got, and you've recorded. I cannot just fill in the column financial year 21-22 with uncomparable data. So that keep in mind, because the moment you fill that in, the question will arise whether those companies are comparable. If not, why have you selected only those companies and not another set of companies? So these unnecessary questions will arise. Therefore, stick to your basics. You know your taxpayer's business. You select those comparables, see what data they report, because that's not in your hand. You go with what is available. And then you update it later. Maybe 6 months down the line, you will have data. You take it from there.
So basically, 3 years before and 3 years later, both the situations 3 years
3 years is what is allowed.
instead of 2.
Yes, 2 plus 1. Current year, 2 prior years.
And so second follow-up question. I read somewhere that 30 days before the date of audit report, we should have completed the study, right?
So nothing like that. There is no timeline to that extent. As of the time you file your Form 3CB, you should have a basis for filing, right? That basis of, so the accountant who is signing the 3CB, if I am signing the 3CB, I should be very clear that this is arm's length, because that's what I'm saying. There's a method that is applied. How the method has been applied, I should be able to say this is the basis, right? So in India, the Rule 10D is very clear. You have to maintain the report. You're not expected to submit. Rule 10D does not say 30 days before you have to maintain. Rule 10D says you need to maintain. So, and it says what you have to maintain, right? So it will have to be furnished at the date. There are countries like Australia where you have to date stamp the report. The report has to be date stamped when it was issued or when it was maintained. So in India you don't have it till now. Yeah, that's the answer.
No, if suppose opinion changes after revision, after 6 months,
Excellent questions. Excellent
it's a
question.
bad question, bad question.
No, it's a fantastic question. Opinion can, because data is not in your control. One of the companies report data and you see that your comparables have reported very high margins, right? How do you say that your transaction was answered? Yeah. Very practical question. And therefore, sir, my suggestion there is the more you know the industry, the better you are in a position to see whether the data is correct. So for example, if you look at logistics industry, you typically, if you work in that industry, you typically know what the margin range is for. If you know, for example, a royalty for a brand, if you understand, how much royalty is paid, you typically know the rates which exist. So definitely you take out outliers. So to answer your question, and I've seen these situations practically, we've had a set of comparables and then we see that it's changed. So therefore what we do is, you maintain a set of additional comparables which have come in, don't document it in the report, keep it with you, because you will have to see whether there's something you missed. I mean, I can't give a right answer here, exact answer here, but I can relate to your question because this can come up. This comes up specifically where your sample is very small. So if you have 5 or 6 companies, you just can't know how their results will be, right? So practical difficulties, sir. I completely relate.
In fact, this year there may be many cases because last 2 years are COVID.
Absolutely, sir.
COVID cases, whereas this year the operating incomes are rising. So if you don't have the data now at the time of filing return,
Sir, but again, MD says data should be contextual. On the day I signed 3C,
Yes.
if there is no change in the material of the business, I am entitled to rely on March 21 data and certify. Tomorrow, if the data works adverse, the assessing officer invokes a power of 10 CA to bring it.
Correct.
I cannot be blamed for that.
No, not this, sir. So
Only
not
thing
the
what can happen is it's a possible TP adjustment which has to be
Yes.
litigated or
Exactly.
argued on. But nobody can be blamed for not predicting an out of. I think on date for Form 3CB March 21 data is valid unless there is a change in the business itself of the assessment.
Exactly. So therefore, it is not for the accountant to say that I have to rely on comparables data. Business has to give you the comparables data, and the data as on the date of signing, you have that basis to certify. Now, after that, if the data changes or there is a material variance, new data becomes available. That was not something which you would have predicted anyways. But practically, we've seen that if the sample size is very small and you're relying on that, then there can be some challenges.
So we should advise our clients.
Yes.
There can be some change.
So the way we can go about this, we can tell them that 6 months post, we look at it again, and that creates also an opportunity for us to engage with them, to say that 6 months down the line, let's look at it again to see whether better data is available. And if so, then should we revisit the approach for the documentation? So is there something more? So the documentation, while it is what it is, you prepare yourself for an assessment to say that I have this other additional data which I can bring on. Yes, sir.
Sir, one thing now, for a company, statutory auditor also tells under section 177 that the transaction with related parties are at arm's length. So he issues his independent audit report along with CARO that yes, fine, it's arm's length. So can a TP auditor who comes after that, his character comes after that, okay, can he rely upon the work of the statutory auditor and his reporting, or will his adjustment will become a contradiction? Because both are the same professionals. So how do the department see it in that way, or it's
Good point.
practically not possible to compare?
So there are objectives. So a statutory auditor looks at true and fair, we look at true and correct reporting. As an accountant certifying the Form 3CB, I have an obligation to report it true and correct. And I also need to confirm the method that the taxpayer has applied in support of the arm's length price. So these are the two things. Now the certificate, if you see the Form 3CEB, nowhere it says you have to say what is the arm's length. So you say what is the arm's length price, but it does not require you to mention how much margins, etc. Right? So to that extent, there is that openness. To answer your question, whether you can rely on the statutory auditor's work to say it's arm's length, it depends on the nature of it. The statutory auditor does not say which method, what. So they looked at certain parameters from their side also to say what they're saying. So there may be an overlap, but I think as an accountant certifying the 3CEB, we'll have to discharge our obligations, relying on the method, how it's applied, and the choice of competitors. Yeah? Good. Thank you for making it interactive, and thank you for bouncing off, throwing some bouncers at me. I hope I was able to tackle it, but there will be questions, there will be more questions, and I encourage you to have more questions. And thank you for your patient listening and hearing. I'll be looking forward to any further opportunities for interacting with you. Thank you.
Thank you, sir. Thank you for sharing your experiences and having a transparent conversation with our members. And of course, members, definitely, I think you would have gained much better than what your knowledge was from the previous session. Before we move to, as a mark of gratitude and respect, I would like to hand over the memento to our speaker. Thank you, sir. Thank you for taking your time out. And we shall reassemble back in another 15 minutes. We have the final session, which is on the TCEB report itself, I think, which we are waiting for a long time, considering the deadlines this month. We'll reassemble back in another 15 minutes. Thank you.